Hello everyone, today is January 7th and this is first session of the Wyckoff Trading course. We're going to have 15 sessions and it's always exciting to start the new cycle, to meet new people, new traders, new Wyckoffans that are coming into our new universe and becoming part of our community, and we welcome you. And for those of you who are guests, just for this session, please enjoy this session. If you have any questions, email me, go to our website, browse through our products, offerings, free offerings. Maybe you decide to attend other classes. And if you have, questions about the course, I will be happy to answer those either via email or today. You could always ask the question, just typing it in. So for those of you who already signed up for this session, there are two groups of people, actually three groups of people for this session that we are having today. The first one is students who already signed up, and you're new students. You haven't taken this course before, so I will be addressing you in a specific way. I will be throughout this whole lecture, I will be giving you certain instructions as to what am I expecting from you a week from now. We'll talk about the homework. We'll talk about some books that I'm going to recommend, some additional material that I want you to read or to view. And the second group is the alumni. And it's always fun to have students who have gone through the course and they come back just because there is so much material, and just to absorb all of this material in one setting could be a little bit hard. And I've had so many great comments from alumni when they take the course for the second time, and obviously we give you guys a discount. So for those of you who are alumni, if you feel that you need to refresh your knowledge, and obviously from each cycle to another cycle, I hope that I'm improving the material, adding to the material, or explaining it in a different way. So hopefully that's going to be helpful. And the third group is guests. So again, for those of you who are guests, welcome. And I'm so happy that you're here. Our Wyckoff price structure series, the beginning, the first 4 sessions, starting with today's session, are going to continue into January 14th, 21st, and 28th. We're going to meet at 3 p.m. Pacific. For those of you who know me, I'm extremely bad with time management just because I want to give you guys a lot of the stuff. And sometimes we kind of, spill over just a regular 5 o'clock ending for the class. So this cycle, and this is the new innovation, I decided that officially we're going to have the class for 2.5 hours from 3 p.m. to 5:30 p.m. Pacific. And as you know, those who attended these classes before, sometimes we go to 6 o'clock as well. Sometimes I feel like we need to finish the exercise, so we need to finish a lecture, and we'll do that. So I would say that, keep like 3 hours for the live session, and obviously you don't have to stay through the whole session if you need to go. It's all understandable. And if you are unable to attend a live session, or we have so many international students that live across the globe. For those of you who live outside of the U.S. Or this continent and this time zone, all of our sessions are recorded, and I post them each evening after the class. And usually, the latest by the next morning, you're going to have the video from the last class and the slides as well. For those of you who are guests, to register for this course, go to our website, wyckoffanalytics.com. You could find the course either on the homepage or just browse through the website and find the correct pages. Sign up. We have a discounted price right now at $9.98. That will last probably until January 14th. and that is for the 15 webinar or recorded sessions. All of the recordings and slides will be available to you guys, who signed up for this class. This particular session will be posted on YouTube channel, so right away, please make a note of this right here at the bottom, left bottom on the slide. I'm posting an announcement that we are recording this session, and it will be on YouTube. If not tonight, then by tomorrow morning. And again, if you need to go, just keep this in mind, and you can watch it at your convenience. A really quick announcement for students who already signed up for this course. There is a specific way how I want to receive your homework. And we've been doing this for over 15 cycles now. And yeah, I think even more, maybe more than 20 cycles. I want you to submit your homework just in one file. I don't need to receive multiple files from you with all of the charts. Please combine those into one file. And my preference is always PowerPoint or the PDF or the doc format, the Word doc format. And obviously, I want to see your first name. You don't have to put your last name, and you could mention what number of the homework it is. I save all of your homeworks. I go through all of them. I review all of them. And the reason why I do this is because I need to understand what kind of mistakes we're making as a group, what kind of commonality we have among us in the way how we view the instructions, the material, and so on and so forth. And I'll talk about this more as I will explain next week's homeworks for you guys. And the last announcements, and this is extremely important for those of you who signed up. Our classes are extremely interactive. The first class is the only class that is a lecture. Everything else is a class where I'm going to be lecturing, and then I'm going to open up the mic to either a specific student or to everybody, and everybody could comment. And as we go through the exercise, I will converse with you. So this means that I would like you to have a microphone available to you. Usually I recommend a headset with the built-in microphone. That works the best. That's what I'm using. As alumni might tell you, or other students from other classes, there is a lot of interaction that happens in this class. The reason why I interact with students is because I want to understand how you think and what is the issue in your analysis. And it's throughout the conversation that the truth kind of comes out, and it's easier for me to teach that way. And it's been like this for years and years, so that's a very common thing for us to do. All right, so we're done with this. Let's look at, and obviously everything that we're discussing today in this lecture is for educational purposes only. You can stop the recording and read the whole disclaimer. What are we going to look at today? So today, as usual in the first class, I'm going to show you some examples of my trades. Yes, I do trade, and I teach what I trade. I trade, my predominant time frame is a swing time frame, and there are a couple of distinctions there that I usually have, either very short swing trades from a couple of days to a week or so, or swing trades that last for months. And then I also started doing, in the last 2 years, a lot of campaign stocks. So I'm going to show you some of those trades as well. And obviously this is just something to highlight the method, the analysis, the execution, the tactics. I'm also a person who is extremely honest with my students, and I show my mistakes, and I think that I need to, I want to be in the space of honesty with my students. I want you guys to show me your mistakes, and I'll show you mine, and together we're going to learn from that. We're going to analyze, we're going to post-analyze, we're going to figure out what is it that we're doing right or wrong. So this is the type of relationship that I usually build with my students. So today we're going to look at 4 trades, 2 of them on the short side and 2 of them on the long side. Some of them were great trades, some of them were good trades, and some of them were bad trades. So we're going to look at where mistakes were made. Also, and this is something that I usually don't do in this class a lot, but whenever the market is extremely active, I tend to discuss the market almost in each class, just because I know how difficult it is, to be exposed to the market. And then when something happens, uh, you know, obviously students have questions, and I'm bombarded with emails, what do you think, what's happening, could you look at this and that? And I will talk also about the Wyckoff market discussion class that we conduct on Wednesdays. Currently we have a promotion, I'll mention that. So I think it's appropriate today very quickly go through the market analysis. Then after that, we're going to do the course overview. I'm just going to touch on the main subjects that we're going to cover in this 4 series. And then after that, we're going to start with the actual course. We're going to start with the introduction to the Wyckoff method. We'll talk about Richard Wyckoff himself. We'll define what composite operator means to us. We'll talk about the price cycle, which is a predominant framework for us. And then we'll start with the main structural concepts, which is a change of character and then the traits of the accumulation and the distribution. And obviously, this is just an introduction. This is something that I'm just giving to you guys to maybe even think about what's coming next, and to think about the benefits of this knowledge and how you could apply this knowledge in your trading. And then we'll definitely look at the homework. Next session, for those of you who already signed up or who are planning to sign up, we're going to go into the details of the price structural analysis. First, we'll review the homework. And by the way, the most common question from students who signed up was obviously about the recordings. So you will have the recordings almost instantly. And then the second most common question was, can I email you a question and ask you if I don't understand something? You can definitely do so, but my preference is to look at your question and answer to the question during the session. There is a much more value for me and for students in the class if I answer your question in the next class. And obviously, I want this question to be related to the content that we are discussing at the time. So any questions that might be covering some material that is ahead, I'm just going to say we're going to study this later on. Or I'm going to say, keep this question for session number 15, which is going to be our Q&A session for us. And then some of the questions that does not require me to write a lot, I might just, quickly write an answer. But predominantly, we will be answering and looking at those questions during the next classes, during the next class. We'll talk in session 2 about reaccumulation and redistribution within the structure of the price cycle. Some distinctions there are, some labeling distinctions. And the biggest question here on the reaccumulation and the redistribution is, let's say with the reaccumulation, is this a reaccumulation or a distribution? And it's, the market obviously gave us such a puzzle in 2018. And I think that puzzle is still unfolding, by the way. It's by no means that we are, out of this formation yet. It's just still keeps unfolding. But we'll talk about the traits of the reaccumulation and the distribution, distinctions between reaccumulation and the distribution, distinctions in labeling, and so on and so forth. And then after that, we're going to go into the details on the price structural analysis, where we will discuss how to identify the phase boundaries, and we'll talk about the phase analysis. Why do we need that? And we'll talk about this today a little bit. We'll talk about phase C identification. For those of you who are familiar with Wyckoff methodology, phase C is kind of like a very crucial phase in the price structure. And within that structure of phase C, we'll talk about types of sprints and shakeouts. Those are specific price action that we identify. They happen in a specific way. So we want to be able to identify those and develop the skill to recognize those as they happen. We'll talk about the sign of strength, and that is beyond phase C, going into the next phase D. So sign of strength is going to act as a change of character. And that's session number 2. Each session will have some kind of homework. So one of the things with students from each of the cycles that I've conducted was that the course is too intense, and that it requires, definitely time to follow the course. And unfortunately, I have only marginally valuable answers to these comments to you guys. I think it's always the pace of a specific student that I'm discussing. If somebody has time and you are very serious about this knowledge and you want to get it as soon as possible, then yes, you have to do the homework each week. And if you skip it, then make sure that you come back, you do it, you send it to me, and then you watch the video with the review, or at least you have some kind of questions. If you don't have a lot of time to do the homework, then I think the best assignment for you is just to make sure that you just go through the video, and as you go through the video and you watch it, I want you to make some notes. And those don't have to be very extensive notes. I just want you to kind of like stop the video, think about the concepts, write those down, write those concepts in your own words. And that would be the best thing. This way you're acquiring the knowledge, you're absorbing the knowledge. And during this course, I will be repeating concepts over and over and over and over again, because that's how our minds work. Our minds are, and especially if you, as myself, not that young, it takes time, to go through some of the concepts, and there's nothing wrong in that. We just need to repeat them over and over. So, as you could already maybe see, I'm extremely passionate about this material, trading in general, Wyckoff method in general, and my students as well. I like to see the progress. I like to push you guys. So I kind of have a tendency to be a little bit, kind of pushing you to the limits that you allow me, to push you. And I think, that's one of the values of this course. And I've heard these comments before from students, that they appreciate my teaching style, and I appreciate that comment, and the fact that a lot of them just come back. But that's the intensity, and that's the style that I have. And again, if you feel that it's a little bit too much, it doesn't mean that you don't have to take the course. Take the course, but go at your own pace. You could always, buy the course and then go and watch the recordings at your own pace. Send me homeworks, send me questions, maybe come to the live session if you want. I would actually do both if you have time, live session and then watch the recording again. Again, this session is being recorded, and I will post it on our Wyckoff Trading Method channel on YouTube. By the way, check it out. We have quite a few videos now, and almost each week there is some kind of update. There is some kind of upload of a new video. So check out our channel. And for those of you who want to sign up, go to our website. Currently, the price is still a discounted price, so make sure that you sign up before it goes up. All right, so let's start with the first case study. And the first case study, well, because there's such a bearish sentiment right now, and obviously, rightfully so, we have had lower highs, lower lows, a conventional TA definition of a downtrend. So obviously, I wanted to look at trades that I've done that were on the downside. So we'll look at Nova Deer and we'll look at Russell 2000. And here are these two trades. First, let's look at Nova Deer. So Nova Deer was a very interesting case study, and I think that it probably requires more time to spend on this and to fully understand how and at what point our bias is changing, and at what point tactically we would be going into this position and establishing a short position. And again, I'm extremely honest with you as to what I thought or what my trades were at one point or another. So as the price was still making higher highs and higher lows, my bias was still to the upside. And in a lot of cases here in this trading range, you would see the benefit of that. Obviously, Nova Deer was such a big leadership stock in this business cycle that we've had. It was one of the best stocks to have for companion. It was one of the best swing stocks as well. So there was nothing wrong here, in my opinion, in this trading range to still have a bias to the upside. Because if you're a swing trader, you're going to initiate your positions close to the support. And then whenever they fail, that's when you want to get out of those positions. So even in this upsloping trading range with higher highs, higher lows, you could manage, being maybe not entirely right on the long-term bias, but be right on the short-term bias and still extract some money out of this. Also, please note that because of the leadership characteristics, because of the strength that this particular stock and the group, semiconductor group, has exhibited for years in this business cycle, the distribution does not necessarily look like a distribution. If you look at the first initial reaction that starts with the buying climax after the climactic run, which we identify in this course as the first point of excitement, look at the initial reaction. It happens on 3-4 days down, very quick sell-off, but then a very quick run-up to the same highs. So what does it tell us? Someone's selling, but somebody's still buying. Some institutions are still seeing some value in the stock. So at this point of time, we're just noticing this price action, price development, and we are saying that there was a change of character in the way how the price was going down on big volume signature and how it quickly recovered. And at this point of time, we would be thinking that we're going to develop a trading range. That's our logic at that time. We know that we're in the potential phase A, which should show us a buying climax, automatic reaction, and secondary test. So all of these 3 points are here in phase A. So again, at this point of time, you might be thinking this could be a reaccumulation. And that's exactly the point of view that I had when the market made a high at the end of January and had a very sharp reaction into the February low. Nova Deer looked very good. It looked much, much better than the market itself. So this is a natural tendency for us to get, and to the stock and to select the stock that has those leadership characteristics during the times of market volatility. Then I'm not going to go through phase B. There are some points that we could talk about, like a minor sign of weakness here, attempts to upthrust, the way and the texture of the price and the volume signature that suggests that there is no supply at this point of time, and that suggests a rally, which does happen, and it happens in very familiar way of how some of the rallies in the trading range develops. And as we are reacting to one half of the range, and on the next rally, we are attempting to overcome the point of upsloping resistance. We see that there is only a temporary commitment to the upside. There is only one bar, one close that is above the previous high. And then the price just quickly fails back into the trading range. So therefore, a question here is, why would this happen? What if the stock is so strong, why is it failing on the breakout? And we obviously could see that as the price goes back into the trading range, there is a gap, there is a down spread that is increasing, and also supply is increasing. Those are all elements of potential institutional selling. So we want to make sure that we are not necessarily shorting a leadership stock right away. There were so many other stocks to short before that, even before October and September, that were already in the downtrend. If you look at some of the stocks, even if we look at Russell, look at the September action compared to other indices and other stocks, you could see that stocks in Russell 2000 have been exhibiting already the weakness. So on the first leg to the downside, this is where you have to be. You have to be in the weaker asset. But as I was actually conducting a presentation for StockCharts.com on MarketWatchers Live, I actually had this position. And I've entered this position on the second leg to the downside. This was the actual bar where I've initiated this position. And this type of the positions I always conduct with options trading. So I just bought directional options with and I have to look it up a little bit better, what was the expiration. But usually for this type of short-term trades, I would have the expiration a month or two away. I'm expecting a drop to the downside, and I'll explain in a second why. But first, let's talk about the timing. Let's talk about the selection. How do we transition from a leadership stock into the stock that is for sale, and into the stock that we could short with confidence? Well, this whole move right here, look what happens here. It's a change of character. The stock is starting to behave in a different way. We're seeing multiple gaps at the open. We're seeing how the down spread is increasing. And comparing this move to the previous moves to the downside in the same trading range, this is probably the most aggressive move to the downside. Not only that, look at the distance that it traveled. This is the largest distance to the downside in this trading range. So if they sell, they actually progress to the downside. We will be discussing in the second portion of the course the relationship between volume and price, or as we would identify it in different terms, the relationship between effort and the result. So we're seeing for the first time that all of the attempts to push the price down in the trading range were unsuccessful. And for the first time, not only the distance of the reaction has increased and the character with which it moves, but also we are seeing the increase of the supply signature, or rather increase of the downward effort. and it's been synchronized with the downward result. And that's what we're looking for in the selection of the stock that has concluded some kind of formation and now shows to us that institutions are selling at this point. So that was the determining factor for the selection of this trade. Everything else was kind of very much mechanical, because tactics are tactics. They're not going to change. We're identifying the first leg to the downside as a sign of weakness, and then look at the rally. A very weak rally. It cannot even come back to one half of the trading range, and then it just fails. So the position was opened on this bar right at the open after the price went through the previous low, and it was an enjoyable trade just because it happened so fast. So from about 236, to 188, that's about what? So almost like $50. And it happens so quick. 1, 2, 3, 4, 5, 6, 7 days, 7 trading days. So a week and a half. And let's see, if you are a swing trader and a short-term swing trader, this is a very quick profit. And also think about the leverage, right? So I'm putting on puts options. So I'm definitely leveraging this position. Now, the reason for closing the position was that we have made a low below the low of the automatic reaction. And we are clearly in the oversold condition here. The volume signature is not that climactic, but we're anticipating that at this point, we might have some kind of stopping action. Why? Well, because selling does not happen consistently. There is always some kind of institutions that are going to find some value as the price moves to the downside. Because if they are holding their position and they are thinking, well, Novadier was a leadership, even in this climate, I'd rather hold on to this stock because it's a leadership stock, then at some point, as the price goes to below the point of where they bought or they thought that there is some value, they're going to step in and they're going to start buying. And we see that from the volume signature. So a lot of the conversations that we're going to have throughout this course is going to be about institutional sentiment. Where do they find value? And where do they find liquidity? Those are the two things that institutions require in order for us to they require in order for them to open the position. So increasing the volume signature suggests increasing the institutional activity. And we see that there was a move to the upside. So some of them were buyers at this point. There was no reason for me to wait for a potential trading range to develop. That was the thought at the time. So the exit was just at the close. And initially, I thought that my analysis was correct. And I thought that after the selling climax and automatic rally, we had a secondary test and we are in phase A, and we're going to continue a trading range until the next leg to the downside as a continuation. Unfortunately, it didn't happen that way. The price just tanked, and it tanked on the institutional capitulation. This is where institutions are just giving up their positions. And we must say that there is a difference between a strong hand or a weak hand. There is, institutions that are acting at this point of time as strong hands, and some institutions are acting as weak hands. So obviously, capitulation happens on the selling of weak institutional hands. And then some of the strong hands that are seeing that there is some value that was not there for them at 190, 180, but they've seen some value at 150, 140, 130. So they are stepping in and they're stopping the price from moving further down by initiating their buy positions. So that was a relatively easy and quick trade. emotionally very stable because the price basically drops, and that's how it usually happens during the bear market. And I really enjoy actually shorting. It's just that we haven't had an opportunity to short for quite some time, and I don't mean just short, specific stocks, but market in general. Talking about the market, so as we are continuing um, with the development of the bearish sentiment. In this area right here, I had quite a few calls to the upside, and I'm actually totally okay with that. There are two things that you have to remember. It's all about the context of where we are and how we trade. And the context here is that as we have already established, let's say, a bias to the downside, it doesn't mean that there are no trades to the upside that we could exploit, even on a short-term basis. So as the market was going down in the second leg right here, we could see that the supply is actually being exhausted. And my call here was to the upside, and I still stand by that. And I thought it was a great call because the call was just for a swing trade or for the rally to happen. And actually, it happens, a couple of times actually um, on other markets, on other indices, that was even better. So I'm going to show you some of the trades in this area right here if you're a swing trader, and how to exploit that. But in this case, a continuation happened after a failed sprint. And we'll talk about the sprint and the definition of the sprint later on, guys, so don't worry about that. But it acted as a failed signal. And a failed signal is probably the best signal in technical analysis that you could find. Why, Bill? Because usually a failed signal will have a very quick shift in the sentiment where the majority of traders were on the wrong side of the trade. And then as they close out their positions, either via stop loss or capitulation, that produces a big counter move to the sentiment that preceded that. And we kind of see that it happened exactly this way. Well, first of all, we are coming out of the apex formation. So here we're thinking that the velocity is going to increase on the way down, if the sprint fails. And as it fails, it gives us a very, very great tactical place to open the position, which obviously I took advantage of. And not necessarily was the best exit right here. And, I think that further down the road, we could discuss this, whether in the Wyckoff Trading course or in the practicum. But I still felt that it was much better than not to be exposed to the market at the time when the bias was so bearish. That's number one. Secondly, at the time, I had some long positions, which were campaign positions or even swing positions, and I wanted to hedge. So one of the ways to do that is exactly this. You could hedge through opening the position, let's say, against some of the positions that you have with the different buys, and that was the idea, and it worked out somewhat okay, somewhat perfectly. I'm just kind of thinking more about the exit here. My preference would be to exit a little bit lower right here on this close. Why? Well, because this shows to us, this bar shows on the volume signature a climactic action. So this was more truer selling climax characteristic than on the previous bar. And the reason why I was thinking, now I'm remembering this, is just the close that had a little bit of the uplift and that we didn't really experience before that. So I remember that was the thinking. Also, look at the oversold condition right here. Even this bar, the exit bar, has been already in the oversold condition. And so therefore, and the volume signature was relatively high. It was one of the highest that we have had. And if we use the analog of how the price actually stops here, there was a suggestion that somewhere here there might be a stop in action. So that was the logic. But definitely could have been a little bit better as an exit. So these are the couple of trades that I've conducted during this bear market. But as I've mentioned, there were some trades that I had on the long side, and I definitely want to acknowledge that. That's number one. I want to explain the logic. I want you guys to understand the logic. So we'll go through that, and hopefully, after this post analysis, you kind of would get a feel of first how I trade, secondly, what I teach, and thirdly, and more importantly, how could we use Wyckoff methodology to define the selection and to define the tactics for us? A question here from Eric. After the sign of weakness to the exit at 188 is better not to operate? Was that the question, Eric? Okay, so after the sign of weakness to the exit of 188. Okay, better not to operate? I don't know, it worked out, right? So I think what happened here is that institutions started to sell, and there was not a lot of selling, actually. If you think about, what this move to the downside, what it had in terms of the force to the downside, we could see the increase in the supply signature. But if we would compare it to the previous attempts, to sell off, it actually was less of a force to the downside. Yet, look at how quickly we move into the downside. So it means that there is no resistance for the price to stop at some point and to react to the upside. There are no bias at this point. So that was the logic of the continuation. Okay, and Eric, hopefully I understood your question. If not, you could just re-ask. Let's look at the next case study. And this one is a Canadian Solar. This particular stock I have been stocking for some time. And I'm going to go through the analysis first to the point of entry so that you would understand the logic of why I'm in this position. I'm still currently in this position. This is a campaign position, meaning that I'm going to hold on to this position for quite some time. I want this position to develop into a sustainable uptrend where not only this stock, but the group itself and the peers are going to confirm that we are in the campaign mode. And it all starts with phase A, where we see the final climactic action with increased spread, gaps to the downside, huge volume signature that represents both increase of the supply and increase of the demand. Increase of the supply from weak hands and increase of the demand from strong hands. And I will teach you how to identify those two categories of traders and on the price action and the volume action. And then multiple tests, which I'm putting into phase A. And then phase B was very interesting. The whole selection for this trade was based on phase B. And somebody might be thinking, who knows Wyckoff methodology, what the heck? What is he talking about? How could you define a selection based on phase B? Well, look at where phase B is residing. It's residing on the top of phase A and early phase B. Also on the top of the potential preliminary support, which happens before the climactic action. What does it tell you? Well, it tells us one thing, that institutions bought into this position and then they didn't want to get rid of it. And the shakeout has specific characteristics that we will study And this shakeout happens so fast, it doesn't produce a lower low relative to the climactic action. It's actually a higher low. And look how quickly there is, after the capitulation, which is still institutional capitulation, they are thinking in terms of the quarters. So multiple quarters, the stock is not showing absolute return, and the stock is not showing relative return. What are they going to do if the stock starts to go down? They will get rid of it. They will get rid of the stock from their portfolios. And this is exactly the volume signature and the price behavior that tells us that story. So out of this, we have a relatively quick recovery, which tells us that this was just an kind of institutional short-term capitulation where a lot of other institutions actually picked up all of their shares. And we're seeing multiple tests. By itself, this low is a test to the previous lows in phases A and early B, then multiple local tests, and my point of entry actually was right here. So what am I seeing here? Well, I'm thinking that from this point on, we probably gonna just go up into a potential sign of strength, into phase D, meaning that we're expecting the price to overcome all of the levels of the previous resistance. And then it doesn't happen right away. There is a smaller shakeout. And, one of the things that, we study is that type of the behavior. When you identify the character of the stock as to how it moves, how the price moves, and obviously that's all being based on how institutions are behaving or how weak hands are behaving. And this type of shakeout is to be expected, as we have seen before this type of the behavior. So you should not be extremely concerned until the price actually hits our stop loss, which is below the May low. So I'm still in this position, even the local shakeout is happening. I see positive actions here where there is a quick reversal of the low where there is some value, and then there is a test. So that looks great. Add to the position here. I just missed that, but wanted to have a confirmation. I wanted to see a positive position before I start adding to the position. So I let this rally run, but this rally was really great. It showed to me that indeed, this is the stock that is worth my attention. And the Wyckoff structure is concluding. We are in the potential phase C, and we have the rally that has a lot of momentum. And remember, guys, from conventional technical analysis, momentum always will precede price. Quickly losing my voice in New Year. The next shakeout or shakeout type of reaction is all market related. It's not stock related, it's not group related, it's all market. Volatility of the market takes even the leadership stocks down. So therefore, we just need to assess as to what kind of damage the market could do to this particular stock. Again, we are out if our stop loss is being hit. There is no question about that, but it's not. Instead, we're seeing higher low, and we still want to stay in this position. And currently, I'm still in this position. The goal is very long term, but the logic as to how I'm getting in, how I'm selecting the stock, or how I'm getting into the stock, or how I'm going through such a period of volatility is all Wyckoff. It's all of this analysis of staying in, adding to the position, or getting out of the position, all based on Wyckoff studies, Wyckoff concepts. And I kind of would like you to see the benefit, through actual trades of studying the methodology and developing the skill of visual recognition of all of those concepts. A couple of questions here. Okay, great. I like that the group is active. This means that we're going to have a good cycle. Hold on a second. All right. So this comes from Charles. Oh, Charles, hi. Just a thought about Eric's comment. By stopping to operate, he might have meant, should one have continued looking for immediate opportunity for new trades? Just a thought. Okay, yeah, I could see that point, Charles. You know, and we're still talking about Novadia trade, so come back to that trade, into that slide. You know, if you have any other thoughts on that, so I could definitely see that. And then again from Eric, in Canadian Solar Phase B, is that an upthrust or upthrust action, and what's the difference? All right, well. Yes, we definitely have multiple upthrust situations here, right? So we have a first upthrust here, another upthrust here, another upthrust, another upthrust. So what are the upthrust? Upthrust are just temporary commitments to the upside above the levels of the resistance, and then almost instant return back into under that resistance. And we're seeing that in all of the cases, this is what we see. The price commits temporarily and then comes back under the resistance almost instantly. Now, the difference between upthrust and upthrust action, and all of them are just upthrust action, in my opinion, at this point of time, is that when we say that this is an upthrust action, we actually suggest a specific bias, which is to the upside. So upthrust action will be discussed during the accumulation and during reaccumulation. Upthrust will be discussed during the distribution or a redistribution. We will talk about this more and in more details, and specifically in session number 3 and 4, we will talk about the distribution a lot. And I will give you a lot of the definitions on upthrust actions, sprints, different type of sprints, shakeouts, and so on and so forth. So it's all ahead. All right, next question. In phase A, which is the automatic rally of the first leg to the intermittent line, or the candle with the weak point into the straight line. Oh, Eric, what's the question then? Which is the automatic rally? Okay, got it. Yeah, so Eric, I definitely feel that there is some knowledge behind it, behind the question. Actually, in my opinion, there are 3 automatic rallies here. You could, just because we're discussing phase A that has this testing, this area is a test, and it's kind of the conclusion of the testing of phase A. We had multiple attempts to go down, so this is of the same magnitude as the selling climax, so therefore we want the test to be of the same magnitude as the climactic action. From that perspective, we might have multiple automatic rallies. And this is, again, something that we'll go into the detail. This is a little bit more advanced, so usually this stuff we leave for the practicum, which is the continuation of the Wyckoff trading course. And this is a little bit more of the advanced concepts, but really good question. From Justin. Ramon, how do you pick your entry point, entry prices? So I've developed kind of like a proprietary reversal mechanism where I'm identifying specific bars that are reversal bars and that act as what I call a point of no return. This type of bars suggest that a reversal has happened and you need to, this would be the most optimal point of entry. It's below this points of entry, or rather the lows, where you could have the best reward to risk ratio. And these are the points of the lowest risk. And as Wyckoffans, we always want to open the position let's say if we're opening the position to the upside after the reaction, after reaction, after reaction, after reaction, there are two spots only. One was identified by Wyckoff himself, and then the second one we added in the Wyckoff trading course. And again, this is something that we'll talk about. We will talk in month number 4 in March, April about tactics. How do we get in? I will show you the Wyckoff way, how his logic worked on the entries and stop losses and exits. And then in the practicum as a continuation, we will definitely talk about this proprietary technique that I'm going to show you. All right, let's look at another trade or another case study. And this case study is about Shake Shack. For those of you who follow my analysis and follow us on either wyckoffanalytics.com or presentations that I occasionally give on stockcharts.com, you're probably familiar with this trade that I've done. I also have a description of the first trade on YouTube, so I'm not going to spend a lot of time on that. That was a really good trade, a really good swing trade. This is kind of like a very typical trade that I would have, in the market that is a bull market. So for the bear market, this type of trades are not necessarily going to work, and you will see this just almost instantly in a second. But this trade was great. It was based on the idea that the earnings are going to be having a favorable reaction, and we're going to have some kind of push into the overbought condition on earnings. And the plan was just to get out of this position on the excitement of weak hands that are still getting into this position. And therefore, I want to leverage this. I'm using options, calls. And this was, one of the profitable trades in 2018, which was, kind of like vastly profitable. And you can see why. The point of entry, the first point of entry was on this bar. Again, this question as to how do you choose your entry points, I will explain later, but as you could see, a little bit premature entry. The add-on was much better, was much more optimal in terms of the point of entry. The price was the same, but I had to sweat it out for a couple of weeks into the next add-on. I'm adding here at the same price because I'm seeing what is happening here on earnings. As the price gaps down, it doesn't really go that much below the low. There is only one bar that commits to the downside, and then there is an instant recovery. So by itself, it acts strong after a negative reaction to earnings. And also, there is a much longer term structure, a trading range that has developed and had a major sign of strength. And we are in the potential backing up last point of support type of action. After that, everything is mechanical, kind of easy. There were some other points where you could add to the position. Here is one, here is another, here is another. And then before the earnings itself, you could actually, if you are a speculator like myself, you could create a position even here with the weekly options. And it worked out really nicely. I'm thinking that this is a buying climax, that we're going to have some kind of trading range at this point. A lot of supply that is coming in on this bar. Again, something that is not necessarily visible to a maturistic eye, but I will show you how to decipher the volume signature based on the price action to understand that the supply is coming in at this point. So I just closed the position, both of them, and obviously we see that supply has come in, but absorption is happening pretty fast. And that was the suggestion, to still keep at least a portion of the position as a continuation. All right, so that was the first trade. But the next series of trades that followed were in a different environment. Remember, the market environment from February, March, April lows, where we had absorption in the market of the supply. So that was favorable for this trade. What happens next is not as favorable. We are in the September, so we already have some slight deterioration. Yet we are in the stock that is a leadership stock. That's number one. Secondly, that shows a correct Wyckoff structure, both in the trading range and also in the uptrend itself. And we are at the point of the support, which I'm interpreting as phase C. I'm entering position intraday on this bar, which acts as a potential sign of strength bar, suggesting that there's going to be a continuation at least to $70. And instead, the price just reverses. It reverses in a specific way. We're still thinking that the sign of strength is developing here. And then a backing up action, a smaller reaction, which should come to the support and then reverse and continue to the upside. And this is where the failure happens. So this bar right here shows that failure. I'm not necessarily closing the position right away. I'm thinking, well, could this be that this phase C was not phase C, but we still were in phase B? And could this be a potential phase C? Not a lot of supply comes in like we've seen, let's say, here. So that was the point of the hesitation. I felt good when the price recovered, but it recovered to the same levels of resistance that we've encountered before. And once after the lower high, we have the next failure, I'm out. And actually, I think that, in my opinion, and I tell my students, that this is a good trade. And again, in your minds, you might be thinking like, wow, what is he talking about? Why is this a good trade? It is a good trade because you give yourself an opportunity to profit from a continuation of an established uptrend. And if you fail, then you just need to quickly close that position and just get out with your risk management. I'm not losing more than I need to, but I give myself that opportunity, and it just didn't work out. The next trade, so if the first trade was a good trade or the best trade or a perfect trade, well, not the perfect, the exit was a little bit premature. The second trade was definitely, I would call it bad trade. So what is happening here? So I think I'm being emotionally caught up here in the previous trade. And I'm playing the earnings. So entry number 5, which actually was preceded by entry number 4. So entry number 4 on this bar right here was an entry pre-earnings. It was a day before earnings. So my analysis shows that there should be some kind of positive earnings. I just don't know what kind of reaction is going to be to the positive earnings. In the bear market, the positive earnings sometimes could produce a negative result. And the institutions will be selling into the strength of weak hands that are trying to react to positive earnings. So therefore, I'm just basically wrong on this entry. But I think where I'm kind of proud of myself as to how I managed that mistake was by recognizing that the earnings day itself has elements of the selling climax. We have an increasing volume signature. We are coming to the point of support, which was defined already by 3 points. So it's a legitimate downtrend. And if this is a selling climax, then we could profit from some kind of reaction to the upside. Each time when we have a climactic action with that increased volume signature, increased spread to the downside, we know that there's going to be some attempt to go up. So what I'm trying to do and compensate for the loss, which I still have as a position, is that push to the upside. And it happened exactly in the way how I was thinking it would. I didn't knew that we're gonna recover that fast, and this bar was really good. And here the question becomes: is in the environment where the bias is to the downside, an attempt to commit to the upside more times than not is going to become an upthrust. Same here in the same spot. So once the upthrust develops and the price quickly comes back below the resistance, there is no reason for me to wait, and I'm closing the majority of my position. Now, I left some, and this is just a negligible position, but still, I wanted to see how I would manage it. And as the price goes down, look at what happens. I'm seeing that the selling is exhausted. I don't see the same type of selling that, let's say, we've seen somewhere here off the top. So this type of selling produced this violent reaction. But here, selling is more exhausted. The supply is exhausted. And we see that also in the spread to the downside. And once we come into the oversold condition, which we're identifying as potential stop in action right here, then I'm thinking that there's going to be another reaction, and we would be seeing probably a reaction back into the point of the resistance. So you kind of could see that I'm explaining to you guys how I'm managing the position even when I get into some trouble. And I think this is a very important skill for us to develop. And it's not like I'm doing this all the time. This is the skill that an advanced trader needs to develop to understand how the structure unfolds and what are the most opportune points for us to act upon. So again, something that we will be discussing during the tactics in March, April, briefly, and then we're going to discuss it more during the Wyckoff practicum. So this is a very interesting case study, on all of these traits. So this is just like, a godsend, because it shows to my students, first of all, the mental outlook, the analysis itself, and tactics. A lot of tactics here with this position. And therefore, it's just like in one example, you have everything: the good, the bad, and the ugly. I love it. All right, some questions here. In Shake Shack, can we assume from entry 2 at 42 the price is increasing is due to no selling? Supply available, institutions have it all. I would like if you can explain the volume signature about that entry 2, please. Okay. So entry number 2. Yeah, and the logic is correct, Eric. The increase of supply shows the increase mostly into the earnings event. And after that, supply is still relatively high on some of the bars, but then it goes down. But not only that, one thing that I want to for you to see is that the not only supply is going down at this point, but demand is increasing as well. And this is also extremely important. Look at the demand on this bar, and even on this bar right here. There is a lot of demand on this bar. Again, something that we will study in the second month. But comparing this area and this area to what we've seen before into the reaction, we're seeing a definitive increase in the demand signature. So what does it mean? Institutions are coming back. They're establishing their positions because they see what? They see value. And also on this type of bars, they see liquidity. Liquidity is extremely important event for them to participate in because of their size. They are huge. They have billions and trillions of dollars. And for them to open a position, someone has to sell in order for them to buy that big position. Again, something that we will be discussing later in the course. Can we assume if we see an increase in the volume as each selling climax in the downtrend channel, that the context is fast price falling and the price is near to go up to the automatic rally? Sometimes the questions are phrased a little bit strange, so we'll work on this, Eric. We're looking at these spots right here. So increasing the volume signature, what does this suggest? Stopping action, right? So why is this a stopping action? Well, because the volume increase usually will have the increase in both, in supply and demand. We just want to understand what dominates at this point. Supply still dominates the demand, but demand is absorbing the supply on the way down, and then it's absorbing on the way up on the next bars or multiple bars. The same happens here. Absorption of the supply is increasing, but demand is increasing as well. Supply is still dominant over the demand, but that absorption, that occurrence of the demand, and then subsequent buying after that, we see that in the next 3 bars, suggests that there is value, there is liquidity for big institutions that are coming in, they are buying, and that suggests some kind of at least attempt to rally. And that's the big distinction, because if the bias is to the downside here, then the distinction is going to be that our trade is going to be just a rally. And I think that in this post-analysis, this is one of the mistakes that I made, later on with this particular stock, that, more so here than here, that we are in the downtrend, and therefore all of the trades, even if you open it at the very opportune time, which this entry was just perfect, you have to be faster getting out of the position. So the exit was relatively okay, but could have been much better. And by the way, guys, during the whole course, this is the mentality that I have. I don't like when people say that, oh, you should not be thinking about perfect entries and perfect exits. Well, I don't think this way. I don't like it this way. I don't like to think this way. What I like is for us to study where exactly we're going to come into the position, at which spots and why, and where exactly we would be exiting and why as well. And I want us to concentrate on perfecting our skills, not only recognizing what is developing in front of us, but also developing tactical skills, execution skills as to where we open the position and where we close, and for whatever reason, everything has to be logical. Otherwise, do not do that at all. All right. Dog is asking, could you speak about establishing reward and risk as it appears sometimes using price support as stop loss leads to potential large dollar percentage loss? Yeah, so I'm going to be extremely quick here, Dog, because this is a little bit out of the scope. So on your point of entry, define your point of entry, define your point of risk with the stop loss, define the risk itself, and that's going to be in dollars here, and then define your target. So for instance, here I've defined the target from the long-term chart. I'm just showing you on this chart, this is where my target was. So the logic here was, as the price exhibits climactic action in the target zone, I'm going to exit. And that's exactly what I've done. So if you understand where your point of entry, and let's say your minimum target of, let's say, $56, and then the risk here is what, about like $2, $2.50, then you could figure out what's the potential. So $18 of reward and then $2 of risk. So what is our risk to reward ratio? It's $18 divided by $2, and that's 9-to-1. So this is a really good reward to risk ratio, and it worked out very nicely. It's a different risk reward ratio here or here, right? So we were thinking about 70 as our target, maybe slightly above as an upthrust, above that, maybe 72, 73, 74. We also could use the PNF here, right, to calculate the potential. Well, it didn't work out, so it doesn't matter at that point. Why getting into the position before earnings? It's gambling. Get in after. This one is from Michael. Yes, I agree with you, Michael. And I would say that for beginners and intermediate traders, don't even do this. You know, if you don't understand how to trade earnings, just avoid them. Although throughout the course, I'm bringing a lot of evidence to you guys that earnings are actually a subject of institutional bias at the time. And I'll talk about this in the course. I'm not going to develop this into a whole discussion, Michael, right now, but just let's discuss this during the course. It's just a big, big topic. Okay, another comment from Michael. So between February 6th and 9th, stopped by the resistance from the top to June 11th, no long positions until chart clear direction. Yeah, and this is what I'm discussing, Michael. Obviously this was ugly, and obviously a lot of the mistakes was made here. But my point here is that when you make mistakes, guys, a lot of you are, and I see because I work with so many traders and so many students, I see that you're withdrawing. And I understand this pain. It's an emotional pain. And usually as humans, we are just built this way to survive, to go away from emotional pain. And market always has an opportunity for us, to produce this type of pain when we are doing something not by the plan, when we are deviating from that plan, when we are misinterpreting the what we see. And I think that's kind of like what exactly happened here in the ugly trade. But it's a very valuable lesson to all of us and to me specifically because I was trading this and just a small portion is still in that trade. What is the lesson? Well, obviously, have a feedback loop into the trading plan. That's number one. Again, something that we discuss in other classes. And then secondly, figure out how to manage your position. Even if you have a loss, especially with options, you have many ways of how to diminish your loss. So that's the way how I look at those things. All right, let's go to the next section. Okay, let's talk about the markets. And this is going to be really quick because I just want you to understand the logic, the my logic that I look at the market and our Wyckoff logic, which by the way, each Wednesday, Bruce Fraser, my colleague, and a great Wyckoff-ian, and we discuss in the Wyckoff market discussion class. Each Wednesday, all of our students come to that class, submit their charts, which Bruce and I review. We discuss the markets every time, and we look at the whole market from the sector perspective, from the industry group perspective, the stocks in those groups. We look at the commodities. We have so many case studies that we go through. We talk about non-Wyckoff-ian topics. Bruce is an amazing storyteller, and he's been in the industry for quite some time, since 1982. So it's always amazing just to hear the stories, from the past, and and also listen to his interpretation. And I'm gonna show you 3 slides from the last Wednesday class, which, by the way, you can find the whole class on our YouTube channel. It was a free class last week. And look at what we've discussed during this class. All of these symbols we put up so that our students would see what's coming in our discussions. All of those were discussed last time. And currently, we have a promotion for this class. You can sign up at $79 a month, which is regular $99, and this offer is going to expire this Wednesday. So go to our website, find that class, sign up, and check it out. And check it out on YouTube, where we just posted that video, and it's a featured video. So what are we looking at here? Well, obviously, we are right here now. So I have not updated the chart. So we are coming back into a trading range or above this local climactic action, which is a bearish sign or a bullish sign. Well, it could be interpreted in either way, and we're still yet to see what's going to happen. So I'm going to show you both of the scenarios. Bearish scenario and analog for the bearish scenario that I'm using here is 2007, 2008 market, where we also had the same type of upthrust action. We had the first leg to the downside that looked like a structural point of the, related to the previous lows. Then we had a rally, an attempt to create the new high and a failure. And even structurally, we kind of have it in the same way, where we see a failure as a lower high, then a potential spring that fails. And remember, that failed signal is the best signal. So again, potential spring, and then the failure. And how did it develop in 2007? Well, at I think in December, the last December session, which was December 16, and we conducted that session, three of us together with Gary Fullett, which was so much fun. Gary is like such a great Wyckoff and just a great person, and he's just always so energetic, enthusiastic. And if you have a chance, go and check out his offerings on Wyckoff products. He is a very, very good intraday trader. He's a very good Wyckoff and Wyckoff experts on volume and spread analysis. And Gary and I, we've conducted together a class on sprints and upthrust. That was a lot of fun and just a lot of great information. So kudos to Gary for doing all this work. So look at how we go into the oversold condition. So we kind of called that continuation into the climactic action just based on this analog. And what this analog suggests was the Wyckoff structure that we could be potentially in the trading range. That's scenario number one, and that's a bearish scenario where we could encounter some resistance at the points of the support that we've encountered before, and then just retest. And a trading range. A trading range like this would suggest a continuation of the down move to the downside like we did in 2007, 2008, and also in 2000 and 2001. All right, let's look quickly at a different scenario. This is not necessarily the scenario that is a preferable scenario for me. I'll show you another bullish scenario that I like more. But I want to point your attention to two boxes here, two blue boxes. One of them comes in 1998. And obviously we could compare these analogs based on the economic environment and where we are in the cycle. What I like about the 1998 scenario is that it produces on a technical basis an oversold condition, and that's exactly what we've produced just recently. And this oversold condition is very significant because we have been in this secular uptrend for quite some time. So every time we've been in the oversold condition, we had out of that a very quick rally up. And if we're discussing a bullish scenario, this would be the most preferred scenario, is just for bulls to have that quick rally. Why? Well, because if everyone is so bearish, who's going to sell? Who else is going to sell if everyone is so bearish? the sentiment is so bearish that at some point, if we are in the reaccumulation, this whole move to the downside will be considered a shakeout rather than a downtrend. And because of that reason, and I always look at both scenarios, by the way, and this is what I teach my students, we always look at both bearish and bullish scenarios. But if we're looking at the instances where the rally is going to be very fast to the upside, and that's going to have some elements of accumulation by institutions, then it makes a lot of sense that out of the oversold condition, institutions are going to cover their shorts, and they're going to see that big institutions are buying in, and trend following institutions are going to also participate in this rally. So one of the bullish scenarios is based on this diagonal, not diagonal, but expanding triangle, where you have different environments in the structure, where you have the reaccumulation texture with the price and the volume showing decreasing volatility, testing of the previous lows, and then the rally that fails and develops distributional structure and then has some kind of short-term downtrend. Look at what has happened in the 1960-1980 trading range in the markets. The same texture. We have the reaccumulation texture first. That suggests that from the lower low, we're going to have either a sign of strength or an upthrust. Becomes an upthrust. A lot of distributional qualities here, and then a short-term downtrend. And then out of that oversold condition, we have a pretty good rally. Well, look at the recent development. Kind of has a lot of resemblances. Reaccumulation texture with the absorption in March, April, May, and the uptrend into the upthrust that develops also into the local distribution with the short-term downtrend. So the key for this analog to work is to obviously make sure that if we're going to have a rally, it's going to be fast, and it's going to quickly bring us to at least one half of the trading range. If, on the contrary, the rally will fail and we're going to have the retest and the trading range, I would favor more of a continuation scenario to the downside. Obviously, with a small asterisk here, if we're going to have something like what we've seen in 2016, then this could be another potential reaccumulation. So these are the things that we kind of routinely, Bruce and I look at WMD classes again on Wednesdays. The current promotion is going to be until this Wednesday, January 9th. All right, let's go to the next slide. And I'm going to speed up a little bit, so I'm going to slightly disregard your questions, guys, for now. Let's see at the end of the class how much time we have. Just feel like we spend a lot of time on the trades, but it was a good segment. So what are we going to learn in Wyckoff Trading course? Well, as I've mentioned, the market structural analysis or the price structural analysis is kind of like the dominant theme with the Wyckoff methodology. If you think about what the method covers, except for the price structural analysis, and we would be talking about volume and price. Volume and price is covered in technical analysis, so you don't necessarily have to have the Wyckoff method, to discuss supply and demand. At the same time, there are obviously some distinctions. But talking about the price structural analysis, what is there for us to explore? Well, we're going to start with the change of character, and this is an extremely important but very simplistic concept, and I'm going to show you guys how the environment changes and how we need to identify that change in order for us to understand how the price is going to behave in the nearest future. That will lead us to that price structural environment, whether we are trending or non-trending. And if we are trending, what kind of trend we are in. Then we're going to talk about Wyckoff phases and Wyckoff events. So whenever we go into the consolidation, we want to conduct a phase analysis. Phase analysis is all about identification of specific Wyckoff events and specific characteristics that belong to those events that help us to identify the bias, that help us to identify the timing of when the price is ready to leave the consolidation, and also a potential character with which the price is going to travel. So these are going to be our goals. Supply and demand is going to help us out, both, not even both, in all of that. It's going to help us out to define the bias and confirm the bias. It's going to help us out to define the timing as to when the price is going to leave. And also, it's going to be crucial in identification of the potential character of the next move. Now, if the bias is the primary concern of the beginner, the timing is definitely more of the concern of the intermediate trader. Character is all about advanced studies. So, and that's kind of like how it is with the course. We first going to talk about the bias and timing, and then we're going to switch in the practicum into the character. One thing about the character that I will say, and then I will go away from this. Character is extremely important, and in some cases, students come to me and they ask me a question. Well, how can you possibly identify the character of the next move? Well, you look at the price and the volume, and it's all there. In a lot of cases, when students come to me, if the beginner comes to me and they ask me, what would you recommend me to read? What kind of books? We have all of the recommendations on our website, by the way, under the resources navigational bar, navigational button. Books that Wyckoff wrote himself, books that people wrote about Wyckoff method, and also books on technical analysis. Those are the books that we recommend to the beginners. To the intermediate and advanced traders, I recommend not to read books. And my only recommendation is to read charts, because a chart always has everything that you need. That statement by Wyckoff, where we have to judge the market by its own action, is a very profound statement for me personally. And the majority of my studies, 99% right now, as after 20 years of reading the books, reading the articles, is all about the charts. There is nothing else. So just kind of like a side note on that. Let's come back to the supply and demand. What's under there that we will be studying? Well, obviously just the volume and price analysis itself and the relationship of the effort and the result. Those are extremely important concepts. And then we will go into the details of the bar by bar analysis, or swing by swing analysis. Bar by bar is the volume spread analysis, as you know. And swing by swing analysis is extremely important, especially in the trading range. We will discuss the volume patterns of different Wyckoff phases in different consolidations, which are accumulation or distribution. And we'll talk about not only the volume characteristics, but the price behaviors for those volume characteristics. And then we'll talk about historical analogs that I use even in the course for the beginners. Then our attention will shift to the relative and comparative analysis. Relative analysis, relative strength analysis is a pretty common analysis in technical analysis, and I'm not spending a lot of time on that because usually students come well prepared, but there are some specificity and especially contextual specificity to the Wyckoff method that I'm going to be pointing your attention to. On the top of that, I'm going to show you some of the things that I do or that I recommend to our students to do in filtering and scanning. And we will use something as simple as StockCharts engine, StockCharts.com engine, to identify, that selection and to go through those filters and scans. And then our last segment is going to be devoted to trading tactics and management. And you kind of have seen a little bit of the preview with some of the trades, some logic there, this is not, and the logic that I've explained is a little bit more advanced even, and with some of the trades, we will be predominantly thinking about the points of entry, where do we open the position and why, our regional stop losses and how we move those, and then how do we exit and what are the strategies on exit that we could use. We'll talk about scaling in, scaling out, how that benefits our risk management profile, and so on and so forth. And then we'll also talk about different tactical scenarios. And this is more an analytical skill than tactical skill here. But, tactics are sometimes more useful than analysis itself. And some of the trades that I do just based on tactics rather than analysis itself. Okay, and as I mentioned before, the course duration is 15 session. We're starting today, so our last session is gonna be on April 15th. The time that we're gonna spend together is 2.5 hours, so this is 37 and a half contact hours for the whole course. Again, right now we are at the discounted price, so take advantage of that. All right. All right, well, finally, we actually starting our lecture in the material. Let's talk about Richard T. Wyckoff himself. Who was he? Well, I think that he was a fascinating character, just because of how his life unfolded. One of the most interesting pieces on Wyckoff I actually read in Stocks and Commodities. Stella Asoba's article on Richard D. Wyckoff, which I believe was published either 2 years ago or a year and a half ago, during the summer of 2017, I believe, maybe earlier than that. It's a 5-part article. I highly recommend it, not as an overview of the method itself. It probably could have been more in depth, although I think that Stella did a good job, talking about the method itself as well. But it was so fascinating to read about the life of Richard D. Wyckoff. He was an editor. He was a trader. He was, an acquaintance to such big operators as Jesse Livermore, Herman Cain, Kahn, and obviously he lived in the era when J.P. Morgan was conducting his campaigns. And what he did is he followed those stock market operators, and he was collecting the data on their trades, interviewing them, and trying to extract their best practices on how they conducted their campaigns. And the whole course and the idea of institutional presence, which he called the composite operator, is just based on his observations of those people. And it's just fascinating to think that he had access, or sometimes direct access, or through the interviews of just living through that time and collecting the information on such amazing traders, at that time. And he codified all of those practices into the course. Unfortunately, his personal life was, somewhat hectic, and he died relatively young, I think. For our time, maybe it was okay back then. He died in Sacramento in 1934, 34, and after the third marriage, which failed, and where his wife took the possession of almost everything. And I think that he was forced after the divorce and into the early 30s, to create something else. So his magazine of Wall Street was taken away from him. His real estate holdings were taken away from him. His family was kind of ruined in a way, and he had a very bad health at the time. Um, and I thought a lot about this, and sometimes I feel like, I'm kind of like, talking to him, obviously, from my mind, and projecting what he would answer to me, and talking to him and discussing, his life and, what has been happening during that time. I felt that he was forced to write the course. This next, this slide right here, the course that he has published in 31, 32, 33, 34. That's the main course that is left for us, that is more sequential as an educational piece. Now, whenever students ask me, and first of all, you could find this online. I believe this is in the public domain right now. Whenever students ask me, do you recommend to read this course? For the beginner, yes. But if you have a chance not to read that course and read it later, I would rather you do that. And there is a reason why. Because that particular course is somewhat outdated. And my recommendation, if you want to read on Wyckoff, read Bruce's blog. And I've mentioned Bruce already multiple times. So Bruce conducts a WMD session with me on Wednesday. Bruce is a blogger on stockcharts.com. A lot of you know that. A lot of you read his blog. But for those of you who are not familiar with his work, please go to stockcharts.com, find his blog. It reads as a book. I'm trying to push Bruce to publish his blogs as a book. That makes a lot of sense to me. So we'll see how that's going to go. But all of our students are required to read his blogs, whether you're going to start from the beginning, and sometimes it reads as a book. He goes through the analysis, and um, there are sequence of blogs on specific instruments that he has, or sequence of blogs on the specific concepts, and so on and so forth. This is definitely a must read, and I would say even before the Wyckoff course itself. So you could definitely study Wyckoff methodology through his blogs. If you don't want to read, come to the classes. If you want like more details, more in depth, and more interactive stuff, then obviously a class would be the best. But definitely check out Bruce's offerings. All right, let's come back. Well, Wyckoff himself, I thought, was not only a great trader, but he was a really good businessman. And sometimes people disregard this, but because I'm in this business, I understand how hard it is to conduct this business, because you always on record. And as you could see, even today, I'm showing you the trades, and somebody's going to say, oh, you shouldn't be doing this, or you shouldn't be doing this, and so on and so forth. So you kind of constantly being bombarded by the feedback of people. And I have a lot of respect for people who do this job, and for Wyckoff himself, because he was such a pioneer in this business. And at one time, he had over 200,000 subscribers. We don't have so many people subscribing to our current services. I must tell you right away. But you know who did that? William O'Neill. And that's why I have a lot of respect for William O'Neill as well. And we know that William O'Neill, on the technical side of CAN-SLIM system, used a lot of Wyckoff ideas. And we saw this as a confirmation, from, the comments of somebody like Chris Catcher or Morales and other people. And even when you look at some of the William O'Neill trades, not the ones that are breakout trades necessarily, but the ones that are long-term trades, they are very much Wyckoff. And we'll talk a lot about, the differences between the canceling entries and exits and Wyckoff entries and exits. There is a lot to learn there in the differences. I have a lot of students from canceling that come and actually really, really enjoying and benefiting the knowledge of Wyckoff methodology just because it allows them to be a little bit more in control on the technical analysis side of things. It's definitely more in-depth studies on the technical basis. And look what Wyckoff have done. He was publishing the ticker. And here, this is so cool, an article with William D. Gann. And that just tells you, like, he was living in such an amazing time for technical analysis, where Dow was creating his theory, where Elliott was, creating his structural theory, where Gann was making all of this trades and just amazing material that he was publishing. And he was living in the times of such amazing stock market operators. He later on became an editor of the Magazine of Wall Street, just a very big subscription. And this is so cool to see also Western Union, Telegram. And then he published quite a few books. Now, also a question about the books. Should I read the books? Yes. If you're a beginner and intermediate Wyckoff, you should definitely have those. They are not necessarily the books where you could extract a systematic approach to trading, but you will find a lot of the great advices and some of the elements on tactics as well. You just would have to read all of this and extract this information from those books. Again, if you want a shortcut to the knowledge, then start with the course, read Bruce's blog, read specific books that I'm giving you, and this is my advice for the beginners and intermediate traders, Wyckoff traders. For the advanced traders, my conversation with you is going to be slightly different, and it's going to be more about, let's put the chart on and let's talk about it. Let's analyze it and let's figure out the way to understand it better. So that's the way how I teach. All right. Let's talk about the composite operator. So what is this concept that Wyckoff talked about? Composite operator, or like Gary always would say, a composite man. Well, a composite operator or composite man is a heuristic. It's a device that helps us to understand how the price structure is being formed and why. So I'm going to translate this into modern terms. We're basically talking about large institutions as a group of investors and traders that influence the price structure in a very big way. Because of their huge size, and think about something like PIMCO or Warren Buffett or BlackRock and multiple other huge institutions. And they could be hedge funds, they could be banks, they could be any type of financial institutions like pension funds, insurance companies. And by the way, those have so much money. And I worked with institutional investors, and I still do. And it always surprises me, the size that they have, the requirements that they have for trading. It's a different type of trading than retail trading. So all of those institutions, if they're conducting their campaign the same way, they are becoming a big force behind the buying and selling in the markets. And that's what moves the price. And that's what absorbs the supply. And that's what creates points of liquidity where they operate. And Wyckoff called it a composite man. And the assumption was that because of the size, they can dictate the potential bias of the next move, which is absolutely true. The more money you have, then the more you invest into the stock, the more you control. So he called it a composite man. He was suggesting that multiple stock operators could be marking up or marking down the price and conducting those campaigns. In our days, I am talking only about the institutions. I will mention the composite man or the composite operator, and you should be able to understand this concept. All right, let's talk about the price cycle. And we also will go into the case study on Apple, where I'll show you how specifically at that spot Apple was selected and how the trade was conducted. But first, let's talk about more of the theoretical price cycle. So as we've talked about the composite operator, I also want to talk about the difference between strong hands and weak hands. We usually would be thinking that, and this is how we unfortunately were told or taught, that the weak hands are always public hands. This is absolutely not true. And actually, if that would be true, the market would have a different look and a different structure. The weak hands could be both public and institutional hands. And as I worked with institutional traders, I must tell you guys that institutions are like us, skin and bone. They are human as well. They are driven by the same emotions that we have. They have the same brain. The only difference between them and us, a couple of things. First of all, it's their 9-to-5 job. That's number one. So they devote much more attention to what they do. Secondly, they have an enormous size, an enormous edge in how they receive the information. And those are the advantages that kind of propel them in a lot of cases to the strong hands. But every year, in every type of market, since I started, teaching, trading, learning this stuff, working in the financial field, every year I read the articles that over 90% of all of the hedge funds are failing to outperform the markets. And that's why the latest idea, and I love Warren Buffett's idea, is that you might as well, in the secular bull market, just invest into the ETFs, market ETFs. You could make a more selective trade like this based on the sectors and groups, not specifically stocks. But it's been very, very successful. And as we know, Warren has won a bet that lasted for what, like 10 years, I think. $1 million that ETFs, market ETFs are going to outperform. That was a very low risk bet. And obviously, Warren knows a lot about that stuff. So we could see how sometimes we could confuse institutions with strong hands. I don't want you to think this way. I want you to restructure your thinking here and think not in terms of institutions and public, but in terms of strong hands and weak hands. And then we're going to say that usually strong hands are going to be the composite operator. Composite operator is going to have huge size. And the time frame for the composite operator is always going to be a business cycle and beyond that. Think about Warren Buffett and his average holding period for a winning or even non-winning stock. It's not a year. It's not 2 years. It's not 5 years. It's a decade or two. I mean, some of the holdings that he has had throughout his career, it's just been there for a long, long time. So this is the trait and the characteristic of the composite operator. Why is this important? Well, because their behaviors are going to be based on the needs that they have. They have a need to establish a huge, sizable position, and they need to hold on to this position for quite some time. They cannot go in today and close the position tomorrow. It wouldn't make sense to them at all. The taxation problems that they will incur, that's number one problem. And then the portfolio rotation, that's number two problem. And then just generally going in, going out, as you might know even from your own trading, is very dangerous because you increase in the number of mistakes that you make. And these are the things that I'm hearing from institutional clients that I have, that those are the big things that they pay attention a lot. Then we're going to have, after the composite operator, which is basically a contrarian in a lot of ways, we're going to have a lot of institutional trend followers. Those are also big size institutions, and they usually look at the market cycle time frame, meaning that their positions are probably going to be beyond the year. This is going to be favorable from the taxation point of view. But they're going to be acting a lot as a composite operator and jump on the emerging trend and jump off the trend once they see the signs of deterioration. And they're going to pick up the time frame that's going to allow them to park the money for quite a long time to ride the whole uptrend and then distribute either on the way up during the consolidation or on the way down. And that's what produces this compounding effect and big profits that they accumulate throughout the years. Also, on the strong hands side, we're going to have professional traders. And here under the professional traders, I probably should mention that there are pros that are institutional pros, and then there are retail pros. Obviously, institutional pros are going to have, somewhat a larger size, but a very serious retail professionals are going to be having also a good size. A good professional is not going to have a small size on equity just because it doesn't make sense. With the risk management, you have to control the risk in a specific way, so you can't commit all of the capital, to a specific position or to, a few positions. You're gonna, control your risk and portfolio risk through some of the techniques that they have, and therefore you have to have a size. So this is still a very sizable group that is a professional group, and in a lot of cases they could be strong hands and be on the right side of the bias. On the weak hands side, we're still going to talk about the retail traders as the public, but we also will talk about institutional and professional managers. And I mentioned to you just a minute or so ago that those people could be wrong too. Our first assumption, when we started studying Wyckoff methodology, that strong hands, institutional hands are always correct. Well, that's not right. I've seen it myself. I mean, I've coached them. I've mentored them. I've taught them the method. I saw their mistakes. A lot of them are just, like us. They just have more time to devote to this craft. And, as we in any profession, somebody is good, somebody is better, and somebody is not that great. And this, the market is unforgiving. The clients are unforgiving. So if you're not progress with your studies, understandings of the market, and your execution, you will be out really fast. So let's look at the price cycle itself. And now let's try to understand the behaviors of strong and weak hands. How would they behave at different spots of the price cycle? Well, first of all, the price cycle itself is just a representation of the accumulation period under the oversold condition, where the sentiment changes from bearish to bullish. that goes into the markup phase based on the absorption of the supply and not availability of that supply by institutions throughout the markup phase. And then into the area of the distribution, the area where big, strong hands are going to start distributing the stock. And that's going to be in the extreme overbought condition, and where the sentiment is going to start shifting like it did in September, October of 2018 into the from the bullish bias or bullish sentiment into a bearish sentiment. And then as this distribution happens, that starts the markdown, a downtrend where on the way down, we're going to see different groups to capitulate at different points. And we'll talk about that as well in more details later on in the course. Now, each group is going to have specific emotional or psychological characteristics. And they behave in a specific way. Shahid, thank you so much for being here. And by the way, if anybody has to go, don't forget that, I'm going to post this video on YouTube so you could check it out later. So yeah, I really appreciate, especially for those of you who are in Europe right now or in the Middle East or in Asia. I understand your commitment and I appreciate this, and I see you. So thank you for that. So let's talk about that sentiment and the psychological landscape and the behaviors of strong and weak hands. Well, we know that in the downtrend, into the conclusion of the downtrend, into the stop in action, which will be defined as a sell-in climax, we're going to have extreme point of fear and capitulation by weak hands. Don't forget that weak hands are not necessarily just public. They are also institutional, professional hands. And therefore, that capitulation by that big amount of money that they carry, the equity that they have, is going to produce that quick move to the downside where they're saying, get me out at any price. I don't care. I'm done. I have too much of a pain. And my clients are on my back. So at that point of time, what this does, it creates, this type of action creates liquidity. And it also creates, with the price moving down, a value proposition to a composite operator. And we must say that it's not just liquidity, it's a high liquidity. And it's not just a value, but it's an extreme value on the long-term basis and a short-term basis. And that's exactly what people like Warren Buffett, Jim Rogers love. They want to come in and they want to take the stock at the best price and with the best availability, where everybody is given up in bunches and they're just saying, okay, I'll take it. I see the value here. And maybe not in 3 months, maybe not in 6 months, I will make money, but in a year, 2, as the price develops into a more favorable structure, and as the business conditions improve, whether it's market conditions, whether it's an industry group condition, and whether this is just a stock-related conditions. They're just basically saying that long-term, I see value. And I see that this is an extreme point. I'm going to come in and I'm going to buy. I'm going to establish that initial position or a chunk of my position. This is going to be the place where we will identify on the chart the first signs of intelligent accumulation by strong hands. And then throughout the whole trading range, a lot of people are still going to be disbelievers of the next bias that's going to come. So therefore, as the composite operator is going to buy on average at the lower price of the trading range, and that would produce the rallies. That's going to subsequently retest the levels of the support. and where the composite man is going to start adding to the position every time it hits their buying point, this sentiment gradually is going to change. Those bearers that were actively and aggressively selling, they're going to see that their trades don't work, or they work but not that great as in the downtrend, and they're going to give up. Some of the weak hands are going to give up their latest additions maybe, or the positions that they have had and they've held even through the downtrend. And Composite Man is just going to scoop all of the latest offering, and that's going to absorb the supply to the point where technically the price will start making higher highs and higher lows. This is where the emergence of a trend is going to occur, and this is an extremely important concept. Emergence of the trend is everything that I talk to institutional money managers. All of their systems are just basically based either on the contrarian value proposition or the emergence of a substantial trend. And this is where what I call the institutional trend followers are going to come in. And they're going to start establishing their positions. That will push the price even further up. The public is still not actively participating at this point because they are scared. They just had the pain of a loss that they incurred throughout the whole trading range. So as the price continues to the upside, this is where they are starting to become very active. It's in the second part of an uptrend of the markup phase. And because they are getting excited here, and they are producing more volume, and they are sustaining the selling by institutions that are selling now into the strength of the weak hands. Once that strength is exhausted, the selling is going to start producing the price structure that's going to resemble more of a consolidation. And when all of the buyers are going to be exhausted by this process, the price will start to deteriorate and it's going to start showing lower lows. By that time, the smart money, the real smart money in that particular position, and by the way, smart money as I see it now with all of this knowledge and experience that I have teaching and trading and working with people, whether institutional, retail people, the smart money definition is only relevant to the last trade that you make. So in a way, it's kind of like as like in NBA, a make or miss league, right? So you always have to be at that performance level where you're not just producing the positive result, but you are actually outperforming the index. Otherwise, why would they give you the money to manage? They could just give it to the market, put it in the ETFs, and just be done with that. So the definition for each of the institutions always changes with a specific trade. And they could be in one trade representing smart money, and in another trade they could be representing, weak hands. And Buffett is a good example. I mean, like, look at his, for instance, the trade in IBM, where he came in and then he had to close out with the loss, and relatively soon as he opened the position. So even here, could be weak hands at some point of time. So weak hands at this point of time are seeing this as a value for the first time. They saw the value on the way up and they were correct here. They were enjoying the profits. They saw the value at the points of the lows at the support level in the consolidation, thinking that there's going to be a continuation. And then they're still seeing the value even as the price starts to deteriorate. And this is where everything collapses, because strong hands are out of the position. Completely, the composite man is out of the position, or it's just hedged in a way that still produces some kind of bearish sentiment. And then the weak hands are just capitulating in the markdown phase. And that's what produces a quick move to the downside. No buying and selling. And not just selling, not an orderly selling, but a capitulation. That's why bear markets are so quick, so aggressive, and so volatile. All right, let's go to the next slide. And guys, I'm gonna speed up at this point again. So I'm gonna come back to your comments maybe a little bit later on. So here is an example of the price cycle with an Apple stock. This is a weekly chart. This is actually not the beginning of the cycle. This is just a reaccumulation of a much larger cycle that has started in 2009 low. And we're seeing the last reaccumulation before the distribution actually occurs. And we're seeing how after the consolidation with the bias to the upside, we have a really good markup phase distribution after that, which leads us to the new low in 2013, accumulation again, and then the next move to the upside, and distribution again, consolidation in 2016, and you all know what has happened here and what has happened just lately. And you kind of could see that this goes on and on and on, and obviously price cycle could look slightly different on a secular basis for different stocks. But for this particular stock, you could take this cycle even from the point of the IPO, from the 1987 to 2003 trading range, which was a huge period, to be in that type of range with one huge big rally in the middle. But after that, it's all like that. This just has been a pattern for Apple. So our goal is to understand what is happening in those consolidations, because it seems that it's out of those consolidations that we have the moves that we want to participate in. And those are directional trades. Obviously, you could use, some hedge trades even in the uptrends and downtrends as well. This is totally acceptable if you understand how to do this. But the course is just concentrating on the directional bias, on identification of that bias, on the timing of when the price is going to exhibit that bias or start exhibiting, on the emergence of the trend, and then obviously on the character of the move itself. And not only that, during the whole markup, markdown phase, especially markup, we are going to have a lot of spots, a lot of consolidations where we're going to apply our Wyckoff analysis, whether it's a phase analysis or price and volume analysis, and we're going to identify specific places of timing where we want to establish a position for the next potential swing to the upside. And hopefully you guys have seen this type of trading, from the case studies that I presented on my trades. By the way, on the YouTube channel, I have also published, quite a few trades, and all of my students here, you guys know that I usually discuss my trades. Again, this is something that I don't shy away. I think that, there should be more of that. It doesn't matter whether it's a mistake or a profitable trade. What matters is knowledge. Can we extract the knowledge from any of the trades? All right. So let's look now at the first reaccumulation box, and let's look at the selection process that we would go through. Oh, another slide. I'm sorry. Okay, so before we do that, couple of things on this slide. This is a very old slide. This is the slide that I created almost 10 years ago. And this slide was based on Hank's Pruden, and I don't know whether it was Hank who kind of originated this idea. I think it was actually originally the idea from the Stock Market Institute. It's an idea of an action and test. The only thing here that I added here is the reaction. Right? So we have kind of like three things that are unfolding. Action to the downside, reaction to that as a stop in action and a consolidation. And then the test of this reaction. Is this test going to fail and the price is going to go lower? Or is it going to stop, reverse, and the new trend is going to emerge? And we obviously could go even into a downtrend, into the consolidation and use the same thing. We could say that selling climax by itself is an action that is being followed by the reaction of the automatic rally, and then being followed by the test of the secondary test in phase A. Or we could say that, as I told you before, the downtrend is an action, and then phase A and phase B is a reaction to that action, and phase C is a test to that reaction to that action. And the main thing that we want to identify within this process is a test in action, because the test in action usually is going to be identified by us as not just the testing tool, but also as a timing tool as well. If the test is successful, then most likely there's going to be a continuation of the buys that we think is developing during the consolidation. So therefore, the timing is going to be identified by us as a potential phase C. So each time we identify phase C, we're going to assume that this is the beginning of the next major move. And that's why phase C is so crucial. Well, if phase C is the low of the trend or the high of the trend, kind of like an extreme point of the trend, the beginning of the trend. And by the way, for those of you who are thinking, well, what about if phase B has, a low, then phase C, or a high, then phase C? You could be right in terms of the actual definition of the trend, but still, we would prefer to be more efficient with our point of entry. We don't necessarily want to enter in phase B into the position. We want to enter into the position when the price is ready to move in the direction of the bias. So phase C is extremely important, and so is phase D. Why is phase D important? Well, because phase D is all about emergence of the trend. And phase D is all about a change of character that is being confirmed. From a non-trending environment, we are switching to a trending environment with a specific bias. Talking about Hank, I mentioned him. Obviously, Hank has passed suddenly. His last presentation was in August of 2017. Even talking about him right now, I kind of feel still so sad. He was a great man. He was definitely my first mentor here in the US, and I owe him my career, basically. And not just from the perspective of the Wyckoff method, which I consider him kind of like he was a guardian. He was always, he would always criticize me for bringing innovation into the method, bringing something like, those Romanisms, students call those Romanisms, like new definitions, new ideas, and so on and so forth. He was kind of like protecting the methodology in a very interesting way. And he not only, initially, and together with Bruce, they taught that class, but I think the first class I actually took from Hank by himself. Not only did he taught me the methodology, but he also taught me a lot of the business, and in a way, the community that we have built with Wyckoff Analytics, it has Hank's presence. It's a lot of the things that I've implemented and our team implemented is just based on Hank's work at Golden Gate University. And I'm just so happy and I feel privileged that I worked so closely with him in the last 6, 7 years. And I've been in his classes. I always was advising students take his class, at least one, at least one. He was a very unique teacher, and a lot of the teaching techniques also I'm taken from him. Just a very extraordinary person and an extremely significant figure in my life, in my not just professional life, but partially also in the personal life, and just his whole family. It just was so nice, and it's still nice to me, and just I'm so sad that he's gone. But he lives through us, and this is the biggest thing that we could do for him and his family, is just to remember him and remember him in the way how he was teaching us, to conduct ourselves and conduct ourselves in the markets. His book, which is called The 3 Skills of Top Trading, is a required book for our students. And I definitely recommend this book to all of you to read. Chapters 3 to 7 specifically talk about the Wyckoff method, and those are the required chapters that I usually ask students to read. In this picture, this award he's holding is the award of the Chartered Market Technician that he received, I think, in April, and he passed away in August. So just months before he passed away. And not only he had received it from the Chartered Market Technician, which is the biggest technical analysis organization here in the US and around the world, but also from IFTA, International Federation of Technical Analysts, at the 2013 conference in San Francisco. And he definitely deserved it so much for the times when the methodology was not in a good shape. For like 20, 30 years, it was not necessarily very profoundly highlighted as a technical analysis skill. Hank and Tom Williams, David Wise, Craig Schroeder, those are the 4 big figures at that time. And then new generation of Wyckoffers came, like Bruce, and we had quite a few Wyckoffers came out of those classes, like Jim Forte, and so on and so forth. And then, my generation came, and we became also, more knowledgeable about methodology just because of him. So just a lot of kudos to him and the way how he conducted his life and the way how he was with students. And just, still so many stories about that. Ditto, Eric. Yep. I miss him too. All right, let's talk about the case study. So this is Apple. We're looking at that trading range before the big move up. Actually, this is the range, and it's a complex range because you have a trading range structure on the trading range structure. Actually, I was in this trade to the downside. Apple was underperforming around this area. This was the trade and closed out somewhere here. So what does this trade tell us? That there is no ability to go down. The supply is not increasing over different other areas, and that suggests a reversal, a change of bias, and change of leadership, which we see on the sign of strength rally. We're definitely exhibiting more over leadership over the market. Looking at the relative strength ratio line, and this is something that we will explore. I will show you how to construct it. I will show you how to use it. I will show you how to interpret it. But here we're seeing that the relative strength is showing outperformance by Apple on this rally to the upside. And if you guys remember the market at the time, the market only has come to the high of the resistance and then went into the shakeout. And even on the shakeout, we see outperformance by Apple, where the market is creating a low low and the stock is creating a high low. So strength, strength, which is great. And this would be, based on the comparative analysis, for us a point of selection. Now, there is one minus to what is going on here, and that is that supply is suddenly up. And we know when supply is going up, we always need a retest. And we have multiple retests which start to create a trading range. And therefore, when we go into the trading range, again, the things that we need to define is bias, timing, and character. And this is not necessarily the sequence with which Wyckoff was approaching this, or SMI was approaching this, or how I was taught at Golden Gate University. This is just what we've created for the WTC course. And this is how I teach the material right now. Those are the three elements that are extremely crucial to me to understand. I want to understand where the price is going to go, when it's going to go, and how it's going to go up. So as we go through the analysis of the consolidation, we are going through the phase analysis. And we are also going through the supply and demand analysis together with how the price reacts to that supply and demand. And we're seeing that supply is diminishing significantly into the area that looks to us as a potential phase C. So that defines not only the absorption of the supply, which gives us a bias to the upside, but it also gives us a timing. The time is now. Supply is very low. It's in strong hands. We could talk about also a short-term underperformance, which usually leads to great buying opportunities within the structure of the whole price cycle. And this is something that we will concentrate on as well. And then obviously the whole campaign, and then the next biggest Wyckoff identification for us would be a change of character. I actually I did not trade this particular rally in Apple, but I had multiple students back at Golden Gate and in my private practice that were trading Apple at the time. I wonder if you could guess where they exited their position. Well, before you even answer this, I'm going to tell you exactly where. Here, here, and here. And why do you think this is? What would be the logic of getting out of this position? I mean, obviously, except for the logic of smaller swing trade, which it wasn't. It was more of a big swing trade like this one or like this one, from one trading range to another, from one structure to another. Well, their logic was that supply is coming here. And my argument with them at the time was that look at the result of this supply coming in. And that's a very, very common mistake that students make. And that's why we're going to study a lot the result and effort. This is one of the most important concepts. If I would be picking the concept to teach, whether the concept of the supply overcoming the demand and the price going down, or a demand overcoming the supply and going up, in comparison to the effort and the result, I would choose effort and the result. Supply and demand is a very simplistic concept, but effort and the result requires an understanding and a visual skill of recognition. And that's exactly what's happening here. And that's exactly the mistake that we were trying to correct at that time. The key to the exit was a different behavior than we've exhibited on the way up. Look at all of the reactions on the way up. They are very small. And even though some of the volume signature increases in there is absorption on the way up. As supply occurs, it's being absorbed and the price moves up. But not on this reaction, not on the automatic reaction, which acts as a change of character. We see that not only supply is emerging in a lot, but it's also very consistent. And this is another definition that we've added to the Wyckoff trading course. Usually volume is being interpreted as just increase and the decrease, but we could see the consistency of selling in this area. As we have seen the consistency of selling here and here, attempt to sell. And what does this suggest? In all of these cases, it suggests a change of environment. So from the uptrend environment, we are going into a non-trending environment or a trending range. And at least minimally at this point, you should start thinking in your head, what should I do? Should I close out the positions? Should I scale out? If I'm anticipating a trading range, is this a very long-term trend, campaign trade for me? Then I should probably check out my PNF targets from back then in 2009, 2010, compare them with the PNF targets that we've just recently had, in the trading ranges. We would be making a decision here, but that decision would be based initially on the way how the price behaves on this reaction. And this is the skill and the knowledge that I'm going to give you guys. All right, 5:30. Let me see. Okay. All right, let me see what we are going to... Let's stop here. So what we are going to do is, obviously, we haven't gone through the whole material that I was planning for today, but this is great because what I'm going to ask you guys, for those of you who already signed up, is I'm going to ask you to read, and I'm going to ask you to watch the videos, and I'm going to ask you to prepare for the second class. And then we will go into the change of character, accumulation, and the distribution. I actually like that a lot. There is a question, have the seminar been recorded, from George? Yes. I'm recording it right now, and I'm going to post it on our YouTube channel, Wyckoff Trading Method. So you could probably check it out tomorrow morning or even late tonight. My team, will upload it and, put the description in. So check it out. Again, for those of you who are thinking about signing up for this course, let me just go to the correct page. So make sure that you go to wyckoffanalytics.com, that you find the Wyckoff Trading course, and just sign up before next Monday, which is January 14th, to get the discounted price. If you have any questions, don't hesitate to reach us at wyckoff.associates@gmail.com. You could find our contact information on our website, and just address it either to me or to our team, and we'll be more than happy to answer. I'm available tonight and tomorrow and throughout the week. So if you have any questions, maybe on the administrative side, or maybe content questions, don't hesitate to contact us. Meanwhile, students who signed up, I will email you tomorrow, and I will assign you the homework, which will be just reading specific chapters of Hank's book, Bruce's blogs, and watching our videos on YouTube. And that will be your homework. And then after the first class, once we cover change of character, accumulation, and distribution traits, then we will go into the homework, and you'll do the actual homework. Well, really great class, really great beginning. I feel like there is a lot of interaction from you guys. So hopefully that's going to just transition into the class itself. Let me just see kind of like last comments here from Doug. Oh, I love this comment. My brain hurts. Great detail session. Yeah, thank you. Thank you, Doug. And I know that you've taken classes from us, so you've been a student, so that's how it is. Thank you very much. Great information to consider. I trade commodities. Was very interested in the program. So let me kind of like address this. And I think that there was another question here on Forex. So I've actually traded Forex for almost 5 years. It just was a little bit tough to intraday trade something like this, living on the West Coast in the US. Just so hectic during the night, to stay up. So I kind of gave it up. But Forex has the same price structure as other price structures. There are some nuances, obviously, volatility, interventions, and then also there is just always the reference to the bad volume data. So my answer to Forex traders is that take the course. Why? Well, because the price structural analysis is still a must. You have to understand the context of where you operate, where you trade. So that's number one. Secondly, some of the Forex traders use volume signature, so you can do that. Thirdly, relative and comparative analysis is still relevant in Forex markets. And one of my strategies was always buying the strongest of the correlated pairs and selling the weakest of the correlated pairs. And you could create pair trading like this or spread trading. You could just choose directionally which instrument you want to pick. So there are quite a few things there on the analytical level that you could use. And then you could also use a lot of tactics. And tactical decisions is something that you have to develop as a trader one way or another. So whenever I talk to Forex traders, I always tell them that this could be a foundational course for you. This could be the course where that kind of like defines the foundation on which you build further up. So consider that. And the same for the commodities traders. I actually love trading commodities. I love trading E-minis. I've day traded E-minis for quite some time. Occasionally, I would make those trades here and there now. I predominantly trade stocks right now and specifically options, but I love trading oil. I trade gold. I trade metals sometimes whenever opportunity presents itself. So to me, trading is not about a specific instrument. Trading to me is about specific opportunity. And I think when you are becoming more and more advanced trader, you will understand that opportunities are very rare. Good opportunities are very rare. And our goal is to recognize them. And even when you recognize opportunities in the market, sometimes you fail, to see them or act on them. And sometimes opportunities come from very interesting places. Sometimes you would be thinking, oh, I trade stocks so that, I'm not going to trade other markets. Well, if you're a speculator and if you're an advanced trader, then you should consider that. Sometimes you look at different time frames and you see how, let's say, a long-term campaign would be much more profitable than, let's say, swing trading or intraday trading. And you should recognize that as an advanced trader. So this is something that we talked more in the practicum, with more advanced students, and this is something that I have to bring you to that level. Okay, great. Next comments and some questions here. Ramon, would be great if you set a number to the slides to have the reference to our notes. Eric, yes, for sure. If you are a student in this class, I can definitely do that for you. I'm not going to distribute the slides for people who are just guests. This is just kind of like a rule for this session. The biggest value is obviously I'm trying to give to the students who already signed up. But once in the class, remind me and I'll do that. What are the tools that are necessary to do the homework? This is a great question from Justin. So one of the things that I want you guys to do is obviously, and I mentioned this, bring me one file, email me one file that is going to be either PowerPoint, PDF, or Word doc. That's number one, requirement number one. Name it correctly so that I would know that it comes from you and that this is the homework number one or whatever. And then thirdly, as you use these tools, you probably have to understand how to capture the screen. Let's say if you're on stock charts, capture the screen, cut and paste into the PowerPoint, and then annotate those. So that's the process. And we could talk more about it if you still have some questions, um, during the next class. So I'll explain more how to do this, and actually, maybe I'll have a slide on some, usual practices. All right. Next question or comment. This comes from Lynn. Although Wyckoff method could fit into any time frame, understanding your trading style is more of a swing trading. Would the course curriculum be suitable for position traders who mainly hold stock for a few months to a year or more? Absolutely. And actually, I kind of slightly disagree with the way, Lim, how you phrased the question, but I understand what you're saying here. A, a good swing trader should understand the long-term campaign. And therefore, I teach you in Wyckoff Trading course a long-term campaign and swing trades within that long-term campaign. So a long-term campaign is going to be something where we will establish a long-term trend first, and then we will seek for the short-term counter trends, which could be a trading range by itself or a reaction within the context of a much larger trend. And you have to understand long-term campaigns. So if you're a long-term campaigner and if you hold in your positions from few months to a year and more, you definitely will benefit from the course. Good question. From Igor, how do you determine the strong and weak currency? So I mentioned correlated currencies, let's say like British pound to the US dollar, and let's say euro to the US dollar. So there are times when they are highly correlated and when they are less correlated, right? So it's during the times when they are highly correlated, and you have to define it. And there are sites that would tell you this, and you could see it from the chart as well when correlation is very strong. It's when this correlation is strong, this is where you want to use this concept and based on the comparative analysis, just to define which one is stronger, which one is weaker. And if you're making directional trades, just to take the trade in the direction of the buys and use that definition. You could also use this for spread trading or pair trading, buying one currency, selling another currency, however you would create that type of strategy, and then trying to define the spots where the spread is increasing, and it always goes up and down, and has, sometimes it has a trend of its own, especially when correlation goes away. So you could create trades out of that as well. So hopefully that explains it. Okay. Craig is saying that my microphone is not working really well and that my voice is breaking up. Is that true for everyone, guys? How's my audio, by the way? I just want to know. This could be just either on your end or my voice could be just going down. And sometimes connection is not that great. So sometimes too much traffic. Yeah, okay, well, let me see what kind of audio we're going to have on this recording. I apologize if not everything was very clear, and Craig, thank you for noticing this. All right, last question, and then we're going to stop. Roman, what's the difference between Wyckoff Trading Course and Wyckoff Practicum? All right, so the Wyckoff Trading Course, think of this as a knowledge, and Wyckoff Practicum is something that a student with the knowledge does not have. That is a skill of recognition of those concepts that you know now. So I always tell my students, knowledge is not necessarily the skill of visual recognition. If you acquire the skill of visual recognition, you will see how the structure, the bias, the timing, the character unfolds. Now, my next statement is going to be that even if you acquired a skill of visual recognition, it doesn't mean that you can execute it. So you have to build a skill of execution. Those are tactics. Even if you conquered that, you still have to conquer the emotional part of trading. And that means that you will have to look deeply into your behaviors, trading behaviors, translate those into your life behaviors, compare those, and figure out how you fit into your trading style and into your methodology and so on and so forth. And this is definitely a very, very advanced level. Whenever I have a beginner or intermediate trader come to me and they say, I want to work on my mental outlook, I say no. You have to study first the methodology. You have to be comfortable with the technical analysis and recognition of those patterns so much that it doesn't distract your brain from concentrating on your mental landscape adjustments. And this is definitely a topic for another long conversation. All right, guys, I think that's it for today. Great session. Thank you for all of your comments, for all of your questions. This has been a blast. A great first session for those of you who signed up or are thinking about signing up. I'm looking forward to working with you. As you could see, a lot of material we have to cover in these 15 sessions. So we're going to start working more next class. Make sure that you have a headset and a speaker as we're going to interact. And I'm looking forward to it. Thank you, guys. Have a wonderful evening. Bye-bye.